Like a sinking ship struggling to stay afloat, economies around the world are on the back foot in the battle against inflation. New Zealand was one of the first countries to begin raising interest rates in the wake of the pandemic, to 5.5% last month, hitting a 14-year high. Now the country has entered a technical recession. That's when an economy experiences 2 quarters of negative growth. The island nation saw its GDP fall by 0.1% in the first quarter of this year. That figure followed a 0.7% contraction in the previous 3-month period.
The economists are also saying, though, that this is what they would describe as a technical recession and that there isn't evidence that New Zealand's experiencing a deep or prolonged economic downturn.
One of the main factors stifling growth is increasing the cost of borrowing. Over in the US, the Federal Reserve decided to keep its key interest rate unchanged, after having raised it continuously since March 2022. The move to leave rates at 5.1%, the highest in 16 years, is due to signals that inflation is somewhat under control. But analysts say it's too early to tell.
Today we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, nearly all committee participants view it as likely that some further rate increases will be appropriate this year to bring inflation down to 2% over time.
The European Central Bank has also increased its benchmark rate by another 25 basis points to 3.5%.
The rate increase today reflects our updated assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission.
Policymakers say inflation remains far too high for comfort. There seems to be no clear signs of acceleration in these major economies looking for rising rates to solve their problems. But as the cost of borrowing rises around the world, more economies could see a slowdown in growth. Emre Boz, TRT World.
Let's get more on this now with Luke Bartholomew in London. He's a senior economist at Aberdeen. Good to have you with us, Luke. Let's start in the US. After a year of consecutive rate rises, the US Fed has decided to put a pause on them, at least for now. What's the thinking behind that, and how long do you expect that reprieve to last?
Yeah, I think this is going to be a relatively short pause, with the next hike probably coming next month in July. The Fed wants to signal that they're open, or indeed that they think they might be hiking again after that later this year. I think we'd be quite surprised if in the end they did end up delivering that extra hike. I think one more is probably going to be enough for this cycle. In terms of why, I guess the Fed is trying to buy itself some optionality and some sort of space to observe the data. And I think there are probably 2 reasons for that. First of all, monetary policy works with these famous long and variable lags. It's very difficult to know in real time how much tightening policymakers have put into the economy, and that brings the risk that you could end up accidentally over-tightening, doing too much and causing a much bigger downturn than is optimal. And the second is that the data has been a little bit mixed recently. Activity data, employment data, consumption data is certainly very strong, but against that there are some cracks opening up. Manufacturing, industrial activity has been very weak now for some time. Perhaps inflation looks like it has turned a corner. And of course, credit conditions are tightening significantly, and those issues in the banking sector, whilst not in the headline, probably haven't entirely gone away. So in that context, I think it makes sense for the Fed just to give itself a bit more time to see how things play out.
It's a different story over in Europe, where interest rates are continuing to rise. Is the ECB close to pausing its own rate hikes like the US has? How is the situation in Europe different from that in the United States?
So the ECB certainly doesn't want you to think it's close to stopping. It's pretty much nailed on the next rate increase and left, I think, very open the possibility that it goes further later on into this year. They want to work quite hard to try and draw distinctions between where they are in the interest rate cycle and where the US is, and avoid market participants drawing too straight a comparison between the two. And to an extent, that is fair. Of course, interest rates are lower still in Europe. It isn't quite as far through its tightening cycle. Inflation in the Eurozone is higher as well at this point. There are some encouraging signs that it is starting to come down, but right now it does feel that Europe's inflation problem is a bit worse. And the other thing is that I guess the Eurozone's inflation problem has been of a rather different sort to the US. The US feels much more like it was extremely strong demand growth that led to an overheating economy, perhaps due to excessive monetary and fiscal stimulus. But one way or other, it's sort of that very strong economy that was generating the inflation. Whereas in the Eurozone, where the inflation seems to come from, is the huge energy price shock that the continent has faced over the last year or so. And obviously that's a much more negative way of getting to high inflation. And that sort of explains why, as we've just found out, that the Eurozone was actually in recession over the course of the winter, yet its inflation is still so high. And I think that does mean that the European Central Bank's policy predicament is perhaps a little bit trickier than the Fed's.
Okay, now in terms of another economy that's just announced that it's in recession, New Zealand, not a huge surprise because interest rates, rising interest rates that is, are designed to cool demand and thereby lower down prices, which could have the effect of slowing down growth. Are there any other economies that we should look out for that could be in the danger of falling into recession themselves?
Yeah, I think the short answer to that is yes. I mean, central bankers would never say this explicitly, but I think we probably are at a point where in a number of economies, the only way in which inflation is going to sustainably come down to target is if there is something like a recession, that at this point, the stickiness of inflation is so embedded that it would probably take just such a sharp slowdown to squeeze that inflationary pressure out, that it's going to have to involve a recession. And dare I say, it feels like the UK probably is top of that list in terms of places that will probably require a recession to bring inflation down. The most recent inflation data continue to show that underlying inflation pressures are too strong, and it is just very difficult to see at this point how the UK is going to avoid a recession. But frankly, even the US might still be in that situation as well. I think the US probably has a better chance of pulling off a soft landing. The Fed is in a better place. That's part of the reason that they are pausing. But yeah, even in the US, it could require a recession to bring inflation back under control. So I think New Zealand is likely to be sort of an early warning symbol as to where a lot of economies could end up going.